Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap, and I'm Ben Brayshaw. I'm joined here again with Dan Michelon, and I'm welcoming back my very good friend, Seth Krussman. We're going to get right into that here in a minute. But if you have questions, you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. I'm very fortunate to work with two very good friends of mine, and I appreciate you both. And I am elated to have Seth back here on the show. So, Seth, welcome.
Thank you very much, Ben.
Yeah. And Dan, hello.
Hello.
And so, Seth, maybe you can just share with our audience. A number of people know you've been on the show for 5-6 years here with us, and you have been the voice of Money on Tap for a long time. So maybe you can share a little bit about what happened and what's going on and how things are going.
Yeah. Well, last I checked, it's been about 215 shows that we've put together here at Money on Tap. Gosh, I have taken a break since, February, when I got a diagnosis of cancer in January and just had to take a step back. Had a little procedure in late February, early March. And since then, you know what, it is what it is. I've just gotten a chance to spend more time with family and look at life differently, take care of my body. My body has been a bit of a research project, it kind of feels like. So, after I take a look at the market and see what's happening there for our clients, off I go to, some physical therapy and other things like that.
Yeah, good. Well, we are super happy. I'm so happy. I mean, Seth's been working with us on and off here and playing his role when he can and how he has through this journey. But it has spun in the favor, and the good Lord has taken care of you. So I'm thankful for that. Yeah, it would be nice to have you contribute where you can, and we're gonna ride and move this thing forward. But before we jump into our show and talk about money in the news and so forth, we've been talking about predictable income in an unpredictable market. I mean, I think that's the thing that has a lot of people calling, a lot of people reaching out to us saying, hey, listen, I thought I could do this on my own. I thought, this was going to work out for me and I was going to make, another 15 or 20% or whatever that you made last year in the stock market and things were going great. And now people have this kind of awareness that, oh, wait, I don't control this anymore. I'm getting ready for retirement. There's these fears involved, these concerns, and we're talking about that. We talked about it last week. We're going to dive more into it today and dig through it. But do you have any thoughts on that, Dan?
Yeah, I mean, I think one of the common things I hear is that, turbulence is expected. Everybody understands the market goes up and goes down. But the combination of the steep drop we've experienced with the rising inflation and rising interest rates and the general cost of living kind of going through the roof is a set of conditions that, separate from the market performance itself, people really didn't see coming and probably weren't prepared to go through. So it has really ramped up the fear factor for sure.
Yeah.
I can tell you this, Ben. There are some truths in this world. And besides death and taxes, we know that people do not like to lose money. I have never come across a single person that says, yeah, that's me. I would like to lose some money. And if you are one of those people listening today, this is a really good show for you, right? Because you probably want to retire at some point in time, or you're all across the spectrum here, folks. And whoever you are, you're going to want to pay attention because we're going to hand you some really critical information to stabilize your income. You know what? In retirement planning, which is the gift of what we get to do here at Brayshaw Financial Group, it is one of the most important factors that we come across when we're trying to establish what the new norm is going to be for our clients and what the opportunities are.
Yeah, no, I think you're right on there, Seth. And then I think the biggest fear people have is, what are they going to think I did? Or why didn't I pull the trigger soon enough? Or the concern of people wondering whether or not they have enough to sit down with somebody. I mean, if you have concerns, it's time to sit down with somebody. If you feel like you're not in control or you're not in a seat that, you feel comfortable in your financial well-being, It's time to work with somebody. It's time to sit down. And I think, but at the end of the day, people think like there's this mountain from us to them sometimes to just make the phone call and sit down. I mean, just call, find out. Who cares? No one's judging. No one's thinking about this. This is about your well-being. This is about you getting the best future you possibly can. That's one of the reasons why we call it our email box is info@yourmoneyontap.com. Because it's about your money. I mean, that's what, if you're not concerned about it and you're not sure and you're losing money and you're concerned, the S&P is down 20%. Actually, it's more than 20%, right? And so if the market goes down another 20%, I bet you there is a massive number of people on this listening to us today that are saying, I won't be able to retire. I just lost 40% of my money. And if you think that that's not possible and you're listening, let me remind you about 2008 and 2009 that people were going back to work. People literally changed their retirement, not goals. They changed everything about their retirement because they lost so much money, not taking precautions in retirement. If you're not a person who's taking any sort of safety in retirement and creating predictable income in this very unpredictable market, it's a buyer beware. And it's something that I would encourage people to sit down with us right away, because there are always things and opportunities potentially that you can do to make your situation better when you're working with an expert in that space, and just kind of figuring out whether it's estate planning, income planning, just general retirement, future retirement. So
it's got to be worth it to hear the options. I mean, just for the fact that the conversation, the consultation's absolutely free to you, why not come in and give us a chance to review what you have and have us give you an opinion on it. Whether it works for you or doesn't, that's okay. That's a chance we take. It's a chance you'll take coming to us, and I think it's well worth your time. I mean, the one thing we've never told anybody is take what you got and go buy scratch tickets. That's your only hope. So that's not what you're going to hear from us. So take that opportunity to come in and hear what us professionals have to say. Right?
I think if our advice is buying scratch tickets, yeah, we're going to start praying for you. So, anyways, but before we talk about more scratch ticket investing, Dan, we're going to jump into money in the news.
All right, first up we have here is an article from Market Watch from Brett Aarons. Here's how much your Social Security check is likely to go up next year. So this is some good news for people, and this is one of the probable benefits from increased inflation is the fact that there is a formula out there that the Social Security Administration goes by to determine what the COLA will be, which is a cost of living adjustment that all Social Security recipients receive on an annual basis, or potentially on an annual basis. Not every year does it go up, but in times like this, there's an expectation that, based upon the average Social Security income, people can expect to see somewhere between $120 and $180 more per month in their check, which is a considerable increase. That's something like a 7.9% increase over last year's.
Yeah, that's very, very high. I mean, I think that's the highest in 40 years or something?
Yeah.
Right.
Yeah. It's crazy. I mean, that's enormous. And they're even talking about there's estimates that could be even higher than the 7.9, going over 10 even.
Yeah, with the actual, the CPI that we talk about all the time, the Consumer Price Index is at 8.6%. So the potential for an even more significant increase is out there for sure.
Yeah, and I think the thing is that, there's two things. I mean, and the article references a number of really good points about inflation actually hurts Social Security beneficiaries. But I think what it doesn't really get too in the weeds on, or what I think all of our listeners probably know without actually putting it in those words, is that inflation is way more than 7, 8, 9, 10%, right? And so people are getting hurt in ways they don't have. I mean, depending on how far you have to drive to the doctors or to work, that is an inflationary event that's affecting you more than someone else. And, 7% ain't going to put a dent in that thing.
Yeah, to kind of the offset of that, according to the U.S. Labor Department, they say this is a separate calculation, but the cost of living index for the elderly rose by 8% in the year over year, 12 months from last May to this May.
Yeah.
Yeah. Just kind of taking a look at some of the historics on Social Security and the increases. It's over the last 10 years, right? There's been hardly any increases. As a matter of fact, we've gone through periods of no increases. And as we've done these inflation shows in the past, That's one of the things that's come up more often than not is how it is, cost of living is not a true measure of what's happening in our financial environment out there. And the Social Security checks really suffering because they're not actually indexing according to what's happening in the inflation arena. They're just changing the measurement out there kind of as they see fit. And that being potentially, I mean, this is kind of big brother stuff out there, right? Who's really pulling the strings, but potentially that being one of the reasons that they're changing that COLA measurement is to affect the underlying cost of Social Security. As I see this, I'm actually relieved to see that, they're not actually trying to change the measure of the COLA here or the CPI to be able to adversely affect the retirees out there. So, I know it's a lagging measure. They're measuring from last year to try to, keep those pay-ups or those payouts going up. But it is it's a benefit that has just been well overdue for our retirees. So congratulations to you guys.
Yeah, no, absolutely. Good point, Seth. Very good point.
One thing we can't help but notice there, for folks in our age range anyway, if you're not going to be on Social Security for another 10 years or so,
they're bankrupting it early.
They're just spending it down a little faster. So some of that private pension opportunities we're going to get into a little later is probably more important to keep an eye on for you.
Yes. I think that's very key here. Predictable income. Next up, we have Value Investors Bet recent market leadership is just the start. This article is by Karen Langley, and this is a Wall Street Journal article, and it was actually very good. It talks a little bit about what we've been chatting about for, I would say, a decade. It's really interesting, is the entire concept and kind of the fruition of how value investors really stand a very good, strong chance for lots of various reasons to outperform growth investors, people who are looking for dividends and yields and the likelihood. And she's interviewing Mr. Arness, managing and founding principal at AQR Capital Management. And he goes as far to say, I can't ever use the word guarantee, but he's insinuating that there's really some major likelihood that this is going to come to fruition, I think is where he's going with that. But he's talking about looking at things like he mentions Exxon and he mentions what were the other companies?
Merck and Molson, Chevron.
Yeah, he's talking about some big boy blue chip stocks producing high yields, which we have been talking about. We've done multiple shows over the last 6 months and even last few years talking about the demand for value-based investing because the bond market has failed. It's failed the investor from a real yield to spin retirement. It has other values for other people. But, the bond market's like 3 times bigger than the stock market. Most people don't even think about that. And on top of it, it's like people need income, and the number of people who need income is growing rapidly with the baby boomers. 20,000 people retiring a day. We're going from 40 million people retired to 120 over the next 20 years. And we only got 320 million Americans in this country. You put all that math together, and it says – we got a whole lot of people looking for income, and so that's a big deal. Yeah,
this is pretty exciting to be able to see some of the story unfold right in front of us, and the story has been through COVID. It's been the technology sector, and whether it's your massive companies out there like your Netflix or Microsoft or Amazon, whoever they are, they have been just pulling the market north at an incredible rate, right? If you take a look at longest bull run in history at an average of 18% returns, since 2009 through 2020, right?
Yeah,
it's this kind of ties into actually the last article. And the story overall, which I think is really a sense of being lulled into an expectation of everything's going to be great. We're going to have 18% returns for from here and forevermore. And here we are talking about, folks, that's just not the reality. There's other parts of this whole financial landscape that you really need to start to pay attention to. And, we just happen to kind of have been a little early on that story. For the last 5 years, we've been talking about this segment of the of our market, which is the value segment, and that's traditionally a very large company paying a dividend, and it is completely underperformed, and it has not been in any way, shape, or form a Wall Street darling. Hasn't been a story that's super out there and people love to talk about. It has been one that we're talking about coming back into kind of almost a place of sanity around what an expectation is or what a realistic option is for people to start to invest wisely. And so I just love the story.
Yeah, I think there's a lot of just real solid conversation around getting your ducks in a row and stop gambling on, GameStop people that are out there. We've done some crazy articles about that and AMC and stuff like that. And the world's kind of coming back to, a level-headed perspective of saying, where am I going to find value? And when I think of value, we think money, we think income, we think dividends, we think yield, we think getting paid. But, I think there's just the value of being and investing in solid, relative companies that, don't have high speculation, that have real profits, have strong balance sheets, that, their expectation in the market is to do well, and they're competitive, and they're not, sliding out of the market. That is a big part of the world around us, and we invest in value-based. We have an entire value-based investment portfolio, which has done tremendously well. And he's talking about his value-based. It's a global one that's done extremely well, and he's talking about the May returns. I think it's a leveraged hedge fund probably perspective because his numbers are very, very good, but I don't know where he's getting that unless you're buying options. So
when you saw that, I went, wait.
Yeah, he's definitely leveraging, and he's definitely using probably options. And
is that legal to print?
It is legal to print, but I wouldn't even say it because it's just kind of it's theoretical, right. Honestly, in my perspective, right. Because you have to be taking way too much risk that some money is not the average Joe taking. So interesting stuff. And that will do it for us in Money in the News. We're talking about predictable income today. We talked about it last week, and we're going to continue to talk about it because if this isn't waking you up to the need to really get help in building predictable income, solidifying retirement, making it a reality. And when we talk about making retirement a reality, we're talking about getting everything organized in a way that that starting next month, the checks are coming through the door, or, hey, last month I didn't take a check because the market went down. How do I remedy that? How do I get myself in a position where I feel empowered and capable of retiring? And get yourself out of this unpredictable environment is something we're talking about for the next few weeks here. We're going to work on a few things, talking from different angles, which I'm really excited about. I think that's a great perspective to do it in. And we are going to be right back. Don't leave us. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
Ben, how often do we have somebody come into the office and they don't have a financial plan? And how critical is it for us to put the pieces together and make sure that their future, their retirement, is a successful experience? We talk about it all the time here at Money on Tap. If that's you, give us a call at 855-226-8551 or info@yourmoneyontap.com. Whether you have 100,000, 500,000, 5 million, look, folks, we have the right planner for you. Whether it's Ben or myself, Seth Krussman, we're here for you to get the plan together and make sure that next step is right.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Michelon and Seth Krussman. Happy to have Seth back again. We are talking about predictable income in an unpredictable market. You know, this is something a lot of people are concerned about, is really getting predictable income. And if that's something you're worried about, and you probably should be, call us at 855-226-8551. That's 855-226-8551. Or you can email us at info@yourmoneyontap.com. You can also reach out to us via email or phone to get a couple of our white papers that are very helpful on building predictable income and what that means for you. There's a lot around this subject, and we're going to be talking about this for a while because I think, honestly, there's a lot of people who are looking for income in all sorts of ways. Today we have, and last week we talked about different types of annuities. We talked about immediate annuities. We talked about fixed annuities. We talked about index annuities. We talked about variable annuities. We covered the gamut of a lot of these annuities, Dan. And but the thing is so many people have a question of like, what is an annuity and how does it work for me and how do I get predictable income? But the market's down and there's a lot of fear around that. I think for today, as we kind of go through that and talk a little bit about some of the breakdowns around us, not just the market, but pensions and some of the things that we're going to talk about today, I think I want to open the door to all of us to just speak a little bit maybe about what you've seen in the market from the drops and what your clients are doing.
Yeah, I mean, this has certainly created a lot of concern out there. And the number one thing that we counsel people about this is that, the opportunity to create that predictable income still exists, even if the market has gone through a downturn, because of the fact that there's certain features within these products, that will guarantee you to pay a certain percentage of the invested asset and whatever it grows to for the rest of your life, every year for the rest of your life. So there's an internal way to quickly offset some of the losses you've experienced just by how these products behave.
Yeah. I was thinking about this, like we have some of our blue chip managed portfolio as of May 31st was up year to date pretty well, which is a unique story. But the conversation I was having with one person was, hey, we've made money this year, believe it or not. And that's great. But you know what? The market's kind of underwater, and what a great time to lock that in and take advantage of, bringing that to that guaranteed perspective. Like you want to lock in an income or you want to lock in a death benefit. You have an estate planning concern. Like, let's take the market issues out of the play. We've made money. We're in a great spot. Let's slide this over here and solve a pension.
Yeah, there's a lot to be said around the psychology around having stability, right? The freedom to go ahead and do the things that you would like to do today and not worry about the things that you want to do tomorrow. And the instability in what the market is, if that's where let's just say the majority of your retirement is at, that can cause some significant internal conversations. And if you don't want to know what I'm talking about your head taking over and saying, what am I doing? Can I do this? Or is this the solution for me? And if that's the wheel that your brain is running on constantly, just know that there's a lot of depth and weight that I feel like we have within the resources at Brayshaw Financial Group to bring the right solution for you. And we're talking about that here right now, which is, solidifying or, I don't know. I like the word codify. That's a good word, right? Codify your retirement plan, or at least a portion of that foundational piece that's going to allow you to have that sense that, the market's going to be a part of your story still, but that's not the whole story.
That's a great point. And, I think, Seth, I wasn't even planning that transition, but the idea that from a foundation perspective, everybody needs a foundation in their portfolio. If you don't have a foundation and you don't know what I'm talking about, or you say, you know what, I'm not sure what that is, that's something you should call us about, because everyone needs a foundational element. We talked about that last week. We were talking about building your house on the sand and the kind of the biblical, You don't do that. In the Bible, it says build your house on a rock, right? So you need a foundation to everything, and that principle holds true here in the financial world. And in reality, a lot of people have this one piece of a foundation that they really look at as, substantial, which is like a pension plan. Like I've got, a lot of our listeners, it might not be a huge pension plan. 15 years ago, 20 years ago, people had much larger pension offerings, but there's still pensions out there. But there's a lot going on with pensions, and I'm just going to pass it over to Dan because I know he's got some things he wants to offer on that.
Yeah, I mean, we did a series of shows, No Pension, No Problem, a while back, right?
Yeah.
And we started to talk about some concerns of what can potentially take place in the pension world by nature of the Pension Protection Act, right? Some legislation that passed a few years back, but we've come into some information here that really demonstrates that some of those fears that we wanted to bring to people's attentions are truly becoming reality. There's some incredible statistics here. So really surprised to find out that over 100 pensions between state, county, and cities across the nation have sold obligation bonds to raise money just to fund the pensions that they have on the books right now, and that's 2 times more than in any year in history, right? There's a lot to that statement. I want to break that down a little bit. So there is more than 100 pensions that sold bonds. So they're literally selling an obligation. They're bringing money in, promising to pay somebody something in order to pay the people that have a pension. Like they're borrowing money to pay the pension payouts for hundreds of thousands of people. Yeah, and it's happening much more often than it ever has before.
Probably millions. I'm probably underestimating this thing.
Well, $13 billion is in fact the total that they've raised, which is 5 times more than any prior year in history.
Yeah.
So this issue that exists in the pension world is growing, and it's growing rapidly. And part of the challenges that these pensions face, like we've talked about with all companies in a rising interest rate environment when the market's down, is they're going to have to pay more and take on more risk just to meet the obligations that they already had on paper, and those were forecasted from 2021. So we're in a significantly worse position even here today than we were then. So that's really a house of cards scenario.
I think one of the things about that, though, that's a little bit interesting is they're borrowing at a very low rate. I mean, they're promising to pay at a low rate when they sold those bonds. So they're using that money is probably cheaper than the money that they have out there. But then again, the market just tanked on a ton of these pension programs, and they're borrowing money to invest too. So let's talk about that.
Yeah, I mean that's the story here, right? Is as these pensions have found, and if you look across public pensions in the United States right now, on average they hold 75 cents for every dollar that they've already promised out, right? So they recognize that there's a gap there, and with fewer employees contributing to pension programs, and then they themselves trying to exit these programs in large scale, they've taken the step of adding risk to their overall ability to pay here and to try and generate some returns. And back in 2002, 33% of the pension funds were in the bond world, which is considered to be safe investing.
Well, I think so for our listeners who have, if you have a pension, you're getting $1,000 a month. Basically, what the pension organization actually has on hand to pay you is about 75 cents of that, 75 cents of each dollar, so $750 is what they actually have on hand to pay you.
Yeah, and they're scrambling to find that quarter.
So you're saying there's $250 right there out of that 1,000 that's coming out of thin air somehow because they don't have it.
Well, yeah, they're borrowing it, right? So they're borrowing in fear of losing money in the market to offset the loss that they don't have, and then they're borrowing money to invest in the market to leverage up, like a margin account. Essentially, they're just doing a cheaper margin account, which I don't blame them for borrowing during this time period because it was lower then. They're probably fixed bonds. I would assume that they're 30-year. They're probably considered.
Probably, yeah.
They're probably considered municipal too, right? So they're muni bonds that are being sold on the open market that that are great rates, but it still is a broken system.
Yeah, I mean the concern is almost regardless of how they perform is the simple fact that they had to take this step. That should concern you as a pension holder if you're out there listening and you're not yet collecting. It would give you, real concern about the reliability of receiving those payouts, which you've banked on. That's a foundational piece. When you come to meet with us and we talk about foundational pieces of your retirement plan, if you're lucky enough to have a pension, that's going to be the first thing you mention. But how secure that foundational piece is,
yeah,
the reason to question.
You know,
Guys, I love a good pension. You know, like I love it. Honestly, it's like one of the best things out there. If you got a pension, folks, and you know that thing is guaranteed, and you know, fully funded, and I mean, that's fantastic. I mean, I cannot think of anything better for your retirement to be able to have that. What scares the heck out of me is that they're running out of money, and the courts are saying, well, you are obligated to pay what you told them you would pay, which makes sense. That's what a pension should be, right? However, what they're doing to compensate for this, and this is what the information from the article I gather, Dan, and is that they're going out and they're creating a much higher risk, or taking on a lot more risk to meet up that that gap to be able to fund the pension, and that's almost entirely the opposite of what the pension world is about, right?
I totally
they're
agree.
all about low risk.
The problem with the pension world is that, you know, they don't know what the market's going to do any more than anybody else does. You know, that's the naivety of all of this. And I think, you know,
Well, can I say something about that?
Sure.
If they did, they wouldn't be in this problem, would they?
Exactly.
Like all those guarantees that they're like, yeah, we can. All the actuaries, all the numbers, all the brains around these things were like, we can do this, and to the level that we're going to guarantee it. And guess what? All the king's horses and all the king's men, right? They just cannot put this thing back together again.
You know, and the other side of this is like we have a lot of people. We're in central New Hampshire here, right? But New Hampshire people with pensions are staring down the gun barrel because it's in the top 10 worst pension funded programs in the country. I mean, if you have a New Hampshire pension, it's like it's really not worth really most of the paper it's printed on, and New Hampshire needs to step it up. But you know, there's so many people we've coached in the pension world of what's going on, and we're going to get to some solution issues around pensions as this show gets moving forward, and potentially what offerings that will happen and things that we'll do. But there are things you can do potentially to mitigate that issue. Like the one thing this world needed to fulfill was the pension. And literally corporate America and most of the world has walked away from pensions because people are living longer every day, and the obligation to pay, that defined benefit, that defined payout they're going to give you each month. The company's saying, we're too busy trying to run the company we do, but to manage your retirement forever is something we don't want to have to worry about. And we're, quote unquote, remember we joked around this last week, Dan, the idea that we're holding you back as a corporation and we want to give you this 401k instead so you can really go make money, and we'll take all this pension obligation off of our hands because they know they can't do it any more than anyone else can.
You know, that sounds really generous of you, Ben. I mean, if you were the corporation I was working for and you were telling me that, hey, we've got a better deal for you here. We're going to put some lighter fluid on your retirement funds over here for you, and this is going to work out well. Why wouldn't I jump on that?
Yeah, no, I mean that's what they've sold everybody is this huge retirement opportunity we've been holding you back from. We've been giving you these outdated grandpa's old pension program that's really not what you need. You really need a 401k, which is the race car that's going to get you to retirement. And that's what people are sold that bill of goods. But now they've mismanaged these pensions. They've underfunded them. And the way that that's happened is they've manipulated numbers on returns, and it's very detailed and complicated. But now every time the market has absolutely crushed it the last decade. I mean, they've actually crushed it the last decade. And when you actually look at the numbers, they still paid out more over these years than they actually made still. I mean, the market was up 18% last year, and, you know, they actually paid out more than that.
It's incredible to think, you know, however they opted to be invested that, you know, coming off of this bull market run that we've had, they haven't been able to fully stuff their coffers. I mean,
you should at least
still run at a deficit.
You should be at least breaking even.
Yeah.
At least breaking even. I want to know, how much are these pension companies paying themselves? How much are the executives making? Where's the loss issues here? How are they underfunded? Who's accountable for this stuff? And if you have a pension, you should be wondering that too. And the worst part about this is that if you go back to our pension shows where we've talked about this, what really is the problem is the fact that you're probably going to get a phone call on an underfunded pension one day, or no, not a phone call. That would be way too personal. It's going to be a letter, if at best, okay, that your pension is going to drop, or just next month it's going to be cut in half, like some of the people that have already experienced it. That the Pension Reform Act, the Obamacare, not Obamacare, but the 2014 Obama Pension Reform Act literally allowed multi-employer pensions to be reduced after application to the government. And if it was approved, people were actually receiving 50 to 60 cents on the dollar, like literally the next month after the application was approved.
This is public information out there as well. I remember going and taking a look, and you could see like the lineup of all of these pensions out there that are applying for these reduction in benefits that they're obligated towards.
Yeah, and the PBGC, the Pension Benefit Guaranty Corporation, doesn't have nearly a drop in the bucket to the potential claims that are around the corner. So if you have a pension, you should be on the phone with us, literally on the phone with us, get our white paper, learn more about this stuff, sit down with us, do a review on your pension, and find out, because there's going to be offers, and you probably have, if you're a listener here today, you've potentially received a pension buyout offer as an alternative to taking your pension, and it might not seem like enough money, but if you do research on your pension, find out if it's fully funded, find out if it's cared for properly, find out if they have enough money to pay you for the rest of your life, because this is the issue. It's not just you they have to pay, and it's not everyone else that has retired already that they have to pay. And that's 40 million Americans that are potentially collecting pensions. There's another 80 million Americans ready to retire. That's 120 million people all going after their pensions over the next 20 years. And if they can't pay today enough in the makings of a rocket market that we've had the last decade, if they can't pay everybody's claims out of their own money in the profits, there's something majorly broken here. I mean, we don't even have a clue how bad this is. You're listening to Money on Tap. We're going to be right back. Stick with us. We're talking about building predictable income in an unpredictable market. You might think you're there. You might not be. Don't be fooled. There's lots of things out there that you need to take care of. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
If you're listening today and your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
And now, here's our Cliff Notes edition of Money on Tap.
CNN, markets are down, but these charts explain why investors shouldn't panic. There's a lot of different moving parts here that make things different than lots of the different crashes we've seen in the market. 2008, 9/11, the years in the crisis with Enron, and all the different things that have happened in our market cycles. There's a lot of things here specifically in this market that are causing an equalizing event of bulls and bears, people buying, people selling, and not this huge, just gigantic sell-off of just every time we bounce down a little bit, we get a massive rally. Why is that? Why is that happening? I think there's a lot of evidence that as you're going down the road, everyone has a for hire sign. The idea that recession is right around the corner, could it happen? Yeah. But there's an entire group of people that say it's absolutely not happening. I was listening to CNBC. There's no chance of a recession. And then there's 5 other people on there saying there's absolutely a recession coming. They don't know. One of the notes in the article says the 14 bull markets since 1932 have returned 175% on average, while the 14 bear markets starting in 1929 have resulted in an average loss of 39%. That means that you need to be in the market. You need to absorb loss. You need to be part of that.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Michelon and Seth Krussman, and you're listening to Predictable Income in an Unpredictable Market. We're all planners and partners at Brayshaw Financial Group, and our headquarters here is in Bedford, New Hampshire. We've got offices coast to coast, and we help a lot of people solve their retirement and estate planning problems. They got tax issues. We work through a lot of this stuff with clients and really create some creative solutions. And one of the things that people do in self-planning, which I think is really what we're talking about today with the pension piece, is that pensions are that foundation, that kind of, you feel it's a rock in your portfolio. And I've got a nice pension. I've got a nice Social Security check. That's another version of a pension. All of these things are under pressure by the volume of people retiring each and every day and this astronomical line of people that are ready to make their claims on the pension fund that's funding you. And we're chatting a little bit about, to catch people up who are just joining us, how pensions have not made enough money over this rocket stock market we've had to even pay the claims they currently have, nevertheless the people that are ready to retire. And building your own pension.
You got me a little over a barrel here, Ben, because frankly, I'm terrified listening to us talk about this because it sounds like Social Security, right? Wow, out of money. What are you going to do? I mean, at least with Social Security, I'm kind of like, well, the government's going to figure it out. They're going to, shoot, they figured out this last round of printing money. They'll just go print some more money and we'll all deal with it that way. But when you're talking about states, they don't quite have the capacity to figure out, or whatever the pension is. They don't really have the ability to do what generally the government might do or other institutions might do. So,
or corporations even, Seth. It's not just the states, right? Yeah, I know I mean that, but it's like companies in general.
Yeah. So, what are we going to do? You got me. What are we going to do?
Well, I talked a little bit about the buyouts, right? So some of our listeners, they get a buyout offer. It's a letter saying, hey, listen, instead of your pension, here's an opportunity for you to take the cash and run. And, for people who are potentially either have received one or multiple ones over their time, or, haven't received one yet, be prepared to get one, because a lot of companies are trying to buy people out at a lower number. What we've found is that we've been able to replace at times more than the pension's offering for a lifetime income or joint lifetime income. And we'll compare those numbers. We do a pension maximization evaluation, and we'll compare what the market offerings are. We use annuities to do that. We talked about a bunch of different types of annuities, and we look at someone's risk, their time horizon, their investment objectives, like put the whole piece together. What are they trying to do with their money? And can we solve that problem? What's nice about this is that the insurance industry is so much more capable and able. This is what they do. The investment insurance agency, industry comes together, and that's what they do. They build a personal pension. And insurance companies don't go out of business. They just gobble each other up. But banks, pension companies cut their payouts. The claims paying ability of the insurance company, on top of all the insurance behind the insurance companies and the reinsurance on top of that and the state insurance pool, is so much bigger than all the pension stuff that we have going on here. And that's a significantly better scenario. And it's on contract law, which means they have to pay it to you when you sign up and you agree. It's an agreement between you and the insurance company.
Well, they've been given no such benefit of legislation that the pensions have, where they can kind of bail themselves out or at least apply to. Their obligations are going to be the full solvency of the company. They have to liquidate literally lock, stock, and barrel everything in order to meet those obligations. So it's probably a more solid rock to build that foundation on.
And you own it. You know exactly what you're going into, and that number's not changing. That's what you're getting. And what's nice about it is we've been able to beat some of the pensions that are out there with some of the offerings. Some of them we haven't. It all depends, right? But what the difference is what's the pension offering today, and what is it going to be tomorrow? I mean, based on these, multi-employer pension, if you're in that category, it's just a matter of time. We already have legislation to reduce your pension. They just got to make the application and justify it.
And not to mention, there's a couple other features that come with annuities that pensions simply don't provide. Things along the lines of, if you were to experience a long-term care event, some of these annuities will double your income for a period of time, while you're facing that issue. Or they can offer some kind of a back-end death benefit that the pension might not. As well, they have increasing income options. So as the market, recovers and then begins to perform again, the paycheck you're receiving can actually begin to go up.
It's funny you mentioned that. I do have a client he had a long-term care feature on an annuity that did double and doubled for 5 years.
That's right.
And that was a huge benefit for him. It's a great point. Go ahead.
I got to ask, the things that you're saying, doubling benefits, taking a lump sum and turning it into income for life. And, but it's not, my grandfather's pension. It's not what I'm familiar with. Some of it just sounds too good to be true, right? There's a little bit of that I've got going on in the background. Like, hey, what's really happening here? Because, I've had the guy stop by my front door and try to sell me an annuity before. And, there's just some of that stuff that I'm wondering, like, what makes the insurance industry so much more stable, or gives them the capacity to be able to provide what it is that we're looking at?
Well, can I spell capitalism?
Are you asking me if I can, or are you going to?
No, I'm just joking. In reality, these are viable businesses that have done actuarial tables on fulfilling these needs. And on top of it, they provide insurance on all of these things. And they're buying various option contracts, and they're hedging their bet on the market to make sure that the downward side of the market is captured. So that's actually a profitable scenario for people who – it's complicated, but they have all these different pieces. And then on top of it, they insure themselves with reinsurance companies, to offset that concern, and they pay a fee. And then they have the state insurance pools, which the amount of money that goes in per $1,000 on the state insurance pools is more than pension companies pay in to the Pension Benefit Guaranty Corporation, which is basically an insurance pool. It's significantly bigger. So the backing, not only is the structure stronger, it's on contract law. It is the claims paying ability, of that organization. And as Dan pointed out, they'll liquidate everything to pay everything, and then you have the reinsurance company. They'll have to liquidate everything on top of it, and then we're going to the state insurance pool. The depth of those dollars is so much bigger than any of these pension companies, and that's the sad part, right? Because at the end of the day, you have your own pension, and it is yours, and it is written in permanent ink forever. This is your payout.
Yeah, these pension companies or the companies that offer a pension, I should say, they're offering this lifetime payout to the former employees, essentially based on goodwill, right? It's because you put in your years of service. The insurance company, they take your money up front.
Right.
It's funded already. Yeah. You funded it the day you bought it.
Exactly. And then the other thing is that everyone wants you to think that your pension's guaranteed. Folks, if you're listening to me and this is going to scare you, it will. Your pension's never guaranteed. The only thing you can put the word guarantee to is an annuity and a contract that you sign with a guaranteed income. That's the only thing. Or if you have a guaranteed death benefit, it has to say it, and pension companies don't have that. And you need to be aware of that. So if you're having an offering, if there's an offer for you to potentially buy it out, or if there is an offer potentially in the future to buy it out, it's something you need to evaluate. You need to go through and look at the pros and the cons. You have to look at the fees and the structures and the expenses. You need to break down what the payouts would be in all different scenarios and see where is the vulnerability and decide, do I want this guarantee or do I want the pension? And do I want this guaranteed income or do I want to take the pension? And you have to look at all those things. And I know there's people out there going to say, hey, listen, my pension's guaranteed. It's XYZ company and it's huge and it's enormous. And I'm going to tell you, we could find maybe hundreds of thousands of people already since that act was passed in 2014 on the Obama Multi-Employer Pension Reform Act that have literally seen their pension drop by over 40%. Literally drop. They were collecting their pension and then boom, the next month it was 40% less or 50% less. So if anyone wants to tell me their pension's so strong that they're guaranteed forever, that's not true. And you need to be aware of that. You need to have a cognizant understanding of that. It's sad because it's really not what was designed to be. And I got to tell you, it's just that companies have taken advantage of building their pensions because it was financially difficult for companies to do that. And I think that the pension companies have poorly managed it.
Yeah, they're poorly managed and they probably overpromised at a point in time. And they've just made obligations that they struggle to meet. And that's evident by the fact that, over 100 of them have had to raise money by selling bonds. Even after doing that, they're still
losing
25% short.
You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan and Seth Krussman, partners and planners at Brayshaw Financial Group. If you have questions, you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. We're talking about predictable income, and we're going to close this out with some real advice on steps to take in evaluating annuities and creating predictable income in this unpredictable market. Now, where do I go? Like, if you want to shop it, you don't want to call us. That's okay. That's 855-226-8551. You don't need to dial that number. But if you want to go shop this and you want to say, hey, I really do want some predictable income. I really like listening to these guys every day, but I'm going to call somebody else that I know and trust. Where are we going, Seth? Where are we talking to?
Oh, yeah. We're talking about life and something financial, wherever. Everybody's got a cousin or an uncle or an aunt that's, out there doing this. And, that's great. I mean, there's a lot of great companies out there that provide some tremendous products. What happens in that vertical is this, though. Agents wind up getting usually compensated a little bit better to just make sure that they're only working with those products and then they're in alignment with the company, or they just don't have the option to really take a look outside of that scope and see what are all the options out here. And when you're making financial choices, I don't know about you guys, but I really, really feel strongly that I want somebody that's able to take a look at the whole industry and find out what's going to be the best fit for me and my personal situation, and not just take a look at what's on the shelf and see, can we make that work?
Yeah, and I think what you're talking to there is independence, right? We're independent advisors, meaning that we have access to basically the full breadth of the industry. Everything that's out there that's available, that insurance companies provide, more or less is something that we can dig into for you and illustrate for you and potentially recommend as a solution for you. What's important to note about that as well is not just our independence, but the licensing that we carry. We can write and do the full gamut of annuity business for you, where some of the folks you might bump into or some of the advertising you might see who recommend advice around annuities, by nature of their licenses, they're limited in what they can speak to. And it's important that you ask that question if you're considering this. Just ask the advisor that you spoke with, what licenses do you hold, and are you able to sell me every type of annuity out there?
And I think that's interesting that you say it that way too, Dan. I think there's the insurance-only guy, advisor, calls himself a financial advisor, but all he sells is insurance. He has an insurance-only license. Not the person to buy an annuity from, personally. That would not be my advice. Secondly, there's also the insurance and securities, like the person who can sell stocks and bonds or just mutual funds or whatever, but also has an insurance license, and they work for XYZ only insurance company. Not another scenario I would not buy from, because they're only going to be able to offer whatever annuities they have in that pot. And then there's the independent side that you're referring to, which is where we operate, where we can offer the whole gamut. We can offer a smorgasbord of all the companies and all the different variables, and we can actually find competition and compare what you're looking at, where you're looking at it, and say, hey, what about this one over here? Does this work better for you? And actually have an open conversation and dialogue about it. I think the only thing I would say, too, is that you could also run into the person who is the money manager only and has an insurance license and is still missing the variable annuity component on a portion of that spectrum. Like, they could offer some of them that work on the managed money side, but not all of them. And so understanding that distinction, because we're all three of those domains, we can look at all three of those perspectives of what makes the most sense for the client. I think that's what makes us significantly different and what allows people to really find the fit for them, where when they buy something, they're super thankful and not super like wondering, hey, what do I own and do I regret doing this? Because that's the one thing you don't want. What you do want is predictable income. What you don't want is the unpredictable market killing you. So that's going to wrap up for us for today. Thanks, guys. Seth, so great having you back. It's awesome to have you.
Good to see you, too. Thank you.
You can reach us at 855-226-8551. That's 855-226-8551. We're looking forward to your call. You can email us at info@yourmoneyontap.com. Reach out, get some of our white papers, learn more about this and how to create your predictable income in the future. We'll be back. We'll see you next week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.